What's going on, guys? Hope you're having an absolutely fantastic day. So today we absolutely need to talk about the Federal Reserve's next move. So just a quick statement before I start the video. So I'm basically having a sore throat, so I might not be able to speak as quickly as I usually do, right? But I decided that this video was quite important to make because there's a lot of important information and also a lot of important thoughts that I have that I might forget after this, right? Before I manage to make the video basically. And also a second announcement would be I'll be making more and more moves in the stock and crypto markets. And also I'll be making more videos, right? Actually, I have a lot of thoughts and all that, but I don't make it into videos because at the time was lazy or whatever the reason was. But starting from now, I'll probably be making 2 to 3 videos every week. So if you do enjoy macroeconomics, cryptocurrencies, and also stock and the financial markets, do hit subscribe and also hit notifications and press on all, right? With that being said, let's start the video. And it's going to be a very difficult one, right? Because Q2 GDP data just came out negative, and now we have 2 quarters of negative GDP data in a row, right? Which in the past terms was a recession, but apparently the White House thinks it's no longer a recession. I don't know what's going on in Biden and his team's head, but yeah, that's that. But this is only an advanced estimate, right? So this could come out to be wrong or what, but I think it'll be quite unlikely to be wrong because it's 0.9%, and even if it comes out 0.4% negative to the negative downside, it's still a negative print in GDP, right? Obviously that would be a very shallow one, but obviously we have to talk about this because it affects how we allocate assets to the market, right? And straight off the bat, I'm just going to talk about the Federal Reserve hiking rates, right? So Fed hike rates by 75 basis points for second month straight. So remember about 1 or 2 years ago when they said they didn't need to hike rates, right? And now they are hiking quite aggressively, right? 75 basis points, right? This is like quite fast even since the 2000s, right? So Fed policymakers have a tightrope to walk as they struggle to cool red hot consumer prices without slowing down inflation growth, right? So I would think that you can't really slow inflation growth without slowing consumer growth, right? Because they cannot control the supply side of the curve, right? But they can control the demand side of the curve, right? So basically what will happen is they have to lower down aggregate demand to meet aggregate supply, right? So both of them match. So in order to do that, obviously they can't control supply, the reason we have inflation is supply is low, demand is currently high, right? So if it was the other way, we'll probably have disinflation, right? Meaning too much supply and too little demand, we'll have disinflation, right? Which is what basically the Federal Reserve is trying to do now. So why does the interest rate even matter and how does it affect you? So interest rate, I'm not going to go into it very deep, but basically there are people with variable rate for their homes, variable rate for their automobiles, and also variable rates for their credit cards, right? And you can think about things like credit card consumption will go down. Basically, if you're forced to pay more on your motor vehicle, maybe you'll think twice about buying the new car, or maybe you'll spend less because you need more money to meet your repayment on your existing car, right? And also it goes for the same thing for your house, right? So take a look at the real interest rate, right? And actually the environment is still very stimulative because the real interest rate is actually inflation minus the nominal interest rate, which is still currently sitting at about negative 6.4%, right? So if it's sitting at negative 6.4%, means you're still getting actually paid 6.4% to borrow money, right? Obviously, we don't get this kind of interest rates. These are like the Fed funds interest rates, right? But we pay a spread on top of this interest rate, which is maybe 1.5% or something like that, right? And even 1.5%, you're still sitting at a negative 5% real interest rate, right? Means your purchasing power goes down 5%, right? And the reason people still think that it's not so black and white, right? Because obviously you can borrow at 5%, negative 5% real interest rates now, but next year inflation might just drop off a cliff, or interest rates might just jump, and a lot of things can change, right? So now the thing I want to talk about is really the Fed and the markets, right? So because this is the true test for the Fed to see that whether they are serious about fighting inflation, right? Because up to this point in the past 6 to 8 months, sure, financial markets have come down. People have been hurt by inflation, and people have been complaining about there's less and less free money out there, right? So there's nothing so broad based as a recession to challenge the Fed to basically say that, are you serious about fighting inflation? And here's why I believe, since Jerome Powell said this in his speech, right? So I may have permission to say it as well, right? So here's why I think this time might be different, right? Because the last time we had the same scenario was in the 1970s, right? And I know there is stark differences because in the 1970s, debt to GDP was obviously lower. We don't have to worry about debt problems when we raise our interest rates, right? But I do think the Fed will continue to raise interest rates to fight inflation, right? Because if they don't at least try to fight inflation, right, act like they're trying to fight inflation, right, the inflation expectations will basically come unanchored, right? Which is basically that everyone thinks that, the Fed doesn't take inflation seriously, so they'll continue spending, which will further drive up inflation, right? And obviously they can't control the supply curve, right? And the supply curve is taking some time to come back online, right? So this is why I say I think this time might be different, right? Because in the past cycles, you see that the moment the Federal Reserve, the moment you hear that there's a recession, right, the Federal Reserve will drop interest rates to zero, print all the money, here helicopter money to everyone, right? But this time we're going into the recession with 9% inflation, right? Which is quite contrary to traditional economics, right? Because if inflation is high, normally it's because there are a lot of goods and services demanded, right? So surely your economy should be strong, right? But in this case, you can see that real GDP is going down, right? And also inflation is at a sky high level. So what's my plan for the Fed rate hike cycle and all, right? So I've already managed to sidestep basically the major decline, right? So you can see that stocks that I wanted to buy from the all-time high, maybe let's say Palantir here, that's not even the top, right, actually. So it's down about 70%, right? I already managed to sidestep those major declines, right? So not to pat my back and say I'm brilliant or what, I would have never bought Palantir stock at this point, right? So but I've already managed to sidestep that major decline. Actually, what I'm looking for right now is whether the Fed is willing to fight inflation or whether they are willing to let inflation run, right? Because there is a very real difference between those two scenarios, right? If they continue to fight inflation and continue to tighten, right, I can see the stocks that I'm looking to buy down another 50%, right? Not because their fundamental value will go down so much, more like the liquidity situation will be so tight that that will end up happening, right? But obviously, I'm not waiting for that. So I'm just going to start dollar cost averaging right now, right? Because obviously you can see if even if we talk about Palantir, I obviously missed the bottom, right? It's about 54% up, right? So maybe hopefully it will continue going down or something like that, right? I thought when the recession was first announced that the stock prices will be hit somewhat at the all-time low, right? That was one of the markers that I was using, right? So a lot of other stocks are still at their all-time low, so plenty of opportunity there, right? So just Palantir as a specific example, I missed the bottom definitely, but other things like let's say Facebook or Baba, right, is still really relatively low at the bottom, right? And even if you talk about Palantir, you see we're still quite close to somewhere at the bottom, lah. So I don't really think that I completely missed the boat or shed the bed or something like that, right? So I would say you really need to look out for a Fed pivot, right? If the Fed changes their stance, right? Let's say because there's a recession, either they drop rates to zero, which I don't see happening, or they start cutting much more slowly, right? Then you'll see the market start to rally, right? And that is, in that case, you might want to dollar cost average a bit more aggressively, right? Because all these basically fast growing tech companies will start to have more growth, right? When interest rates are lower, they will have more growth, and also at the same time, the discount rates to find intrinsic value will be much lower, right? So you will basically have multiple expansion, and also you have earnings expansion, right? So basically, this is what in 100 baggers they call the twin turbo, right? And this is what causes stock prices to explode up, right? Because you can see a lot of stocks and companies, like even Apple, for an example, I think when they did their 100x, right, their earnings maybe went up 20% or 30% was based on the earnings, right? The rest was just share buybacks and also the multiple expansion, right? So yeah, these are three maybe of the examples that I would give out, that I would be personally dollar cost averaging. Obviously not financial advice, right? But yeah, I would really consider like Palantir Technologies, Facebook. Facebook is a bit of a question mark right now because I'm really not sure whether their business is structurally broken, because advertising, they don't seem to find a way across this Apple thing, right? And I'm also still really thinking like, what happens if Android does the same thing, right? Basically, Google thinks that, oh, we also want to do the same thing as Apple, right? So what happens to Meta's business model after that happens, right? That is also a big question mark, right? So maybe start a small position and continue contemplating and thinking and really have deep thoughts of what will happen, right? So in Facebook's case, I think ultimately their metaverse bet will pay off, right? Because you see how old Mark Zuckerberg is, and you see how ambitious this guy is and how smart he is, right? I don't think this guy will fail, right? He is like I think like, besides, I once heard this, right? And I think I tend to agree, right? Besides Elon Musk, Meta Platforms is probably like one of the most like product focused kind of company, right? Because you think of them and you think of maybe like a Microsoft model, right? Because Microsoft copies a lot of things, right? And Facebook also copies a lot of things. But the issue is they do it so well and they take market share from the original people who came up with that business model. Look at Snapchat. Snapchat was like in 2017 such a big thing, and then Instagram came and basically took their pie, right? So I'm not sure whether the same thing is happening with TikTok taking Meta Platforms pie. But yeah, that one is still up for grabs, right? Still a lot of thinking and a lot of basically deep thinking to think about before really diving in, right? But since the P ratio is really low, right, there is maybe a margin of safety for even earnings to fall 50-60%, right? But wouldn't think that would be a good scenario, right? Because if you keep with the same P ratio, basically the stock will be also down 50-60%, right? So Baba is another one that I'm looking at. I've been looking at this since like maybe since somewhere around here lah. So I'm definitely not early or what, right? But I've just been looking, so I haven't been buying, right? And at this point, I think it's super like cheap, but at the same time, still cheap might get cheaper, right? As people always say, right? But I really don't factor that in. And I think like if you, so I think me personally, I would limit my own exposure to maybe Chinese companies to 10, maybe 15%. I'll be willing to double up to 30%, right? If let's say Alibaba gets delisted, it's at $20 per share on the Hong Kong Stock Exchange, you bet your ass I'll double down and I'll go up to 30%, right? But I at the moment, yeah, just nibbling at all these things because I think a lot of macroeconomics and news headlines can still cause the stock prices to continue going down, right? So that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button beside it, press all notifications, and comment below, right? What do you think of these stock picks? If you want a full analysis, do comment below, right? Because I'll be more than willing to make a full analysis because I've already been studying these companies in very, very high detail. And with that being said, hope you have a fantastic day ahead and peace out.